Imagine it's 10 years from now and you chose the day trading path. Every morning starts the same way, screens glowing before the sun is fully up, coffee in hand, charts already moving without you. You tell yourself you like the intensity, the feeling that today could be the day you nail it, the day you catch the move that makes the month. Now imagine instead you chose a different path. You bought a simple low-cost index fund every month, automated it, and then closed the app. You focused on your career, your health, your relationships. 10 years pass in both scenarios. Same starting capital, same decade of market history, two completely different lives. One of these paths statistically destroys wealth for most people, and today I want to walk you through what actually happens over 10 years so you can decide which identity you want to become. Because this isn't really about trading strategies. It's about structure, behavior, and who you are when no one is watching. Let's start with the day trader identity. It feels powerful. You are active. You are engaged. You are not average. You're reading price action, reacting to news, scanning for setups. You feel skilled. You feel productive. There is a constant feedback loop. Wins feel validating. Losses feel like puzzles to solve. You believe if you just refine your system, tighten your risk management, study harder, you can crack it. On the other side is the index investor identity. It looks boring from the outside. You buy the market, you accept average returns. You don't try to outsmart anyone. There's no rush, no flashing green candles. You automate contributions and move on. It almost feels too simple, which is exactly why many people dismiss it. So which one feels more like you right now? The one chasing precision and control, or the one embracing process and patience? Before we go further, we need to look at the evidence because opinions don't compound, numbers do. Multiple large-scale studies across different markets show the same pattern. A well-known study from the Taiwan Stock Exchange tracking thousands of day traders over years found that only about 1% were able to earn persistent abnormal profits, net of fees. 1%. Another study out of Brazil examining individual day traders in futures markets found that after 300 days of trading, approximately 97% had lost money. Not underperformed, lost money. Research from professors Barber and Odean has repeatedly shown that high turnover investors significantly underperform the market, largely due to costs and behavior. And long-term performance reports like Spiva consistently show that the majority of active fund managers, professionals with teams and resources, underperform their benchmark indices over 10-year periods. If professionals struggle to beat the index consistently, what does that imply about retail day traders competing intraday against institutions with algorithms, co-location servers, and teams of PhDs? This isn't about intelligence, it's about structure. Short-term markets are incredibly competitive. In many ways, they are close to a zero-sum game before costs and negative-sum after costs. Every trade has a spread. Every trade has fees. Short-term gains are often taxed at higher rates than long-term capital gains. Even if you have skill, friction works against you. You're not just competing against other individuals scrolling on their phones. You're competing against firms whose entire business model revolves around capturing small inefficiencies at scale. They don't get tired. They don't feel fear. They don't second-guess. They execute. Now, to be fair, there are people who succeed at day trading. That 1% exists. But what does their life look like? They treat it like a business, not a hobby. They have strict risk models. They track data obsessively. They size positions carefully. They often have years of experience, sometimes institutional backgrounds. They understand variance deeply. And even then, performance can fluctuate year to year. So the real question isn't, is it possible, Mags? It's, are you building a trading business with the discipline of an entrepreneur? Or are you chasing dopamine disguised as strategy? That question matters. Because most people aren't trying to build a trading firm, they're trying to build wealth. Now let's zoom out to the index investor. Historically, broad equity markets like the S&P 500 have returned roughly 9 to 10% annually over long periods, though of course there are volatile years. Over 10 years, even with recessions along the way, markets have often delivered strong cumulative growth. The key difference is not that index investing guarantees returns, it's that it aligns you with the upward bias of economic growth rather than pitting you against other traders in micro timeframes. When you invest in a low-cost index fund, you own businesses. Real companies generating profits, innovating, expanding. You reduce turnover, you minimize fees, you defer taxes longer, you let compounding do the heavy lifting. Imagine investing $1,000 per month at 9% annually for 10 years. You would accumulate roughly $190,000. Stretch that to 20 years and you're approaching $600,000 to $700,000. The first decade feels slow, The second decade accelerates. That's the quiet power of compounding. It's not dramatic day to day, it's relentless over years. But beyond returns, I want you to think about lifestyle. 10 years later, what does each life feel like? The day trader's schedule revolves around market hours. Income may be inconsistent. Stress spikes during drawdowns. Confidence fluctuates with performance. Vacations are harder because markets don't pause. Taxes are more complex. Emotional volatility becomes normal. The index investor, meanwhile, checks in occasionally. Contributions are automated. Market crashes are uncomfortable but framed as long-term buying opportunities. Time is freed up for career growth, fitness, family, creativity. Stress still exists, but it's not tied to minute-by-minute price movement. Which life feels anti-fragile? Which one scales better with age? Which one lets you build optionality rather than dependency? And here's an important nuance. Even if a day trader matches market returns over 10 years, they have traded something in exchange. Time, attention, cognitive bandwidth, emotional energy. Index investors trade ego and excitement. They give up the thrill of calling tops and bottoms. They accept that they will never perfectly time the market. But in exchange, they gain simplicity and scalability. Over 10 years, simplicity compounds too. There is also the data on investor behavior more broadly. Dalbar studies have shown that the average investor often underperforms the very funds they invest in because of poor timing, buying high during excitement and selling low during fear. Day trading amplifies this timing problem because every decision is magnified. When markets fall sharply, the index investor who keeps contributing may recover as markets rebound. The day trader might attempt to short the decline, get squeezed, and then hesitate to re-enter. Behavior becomes the edge or the enemy. Now, I don't want to oversimplify. There are scenarios where active trading can make sense. If you genuinely love markets, if you're prepared to treat it as a profession, if you are adequately capitalized and emotionally stable, and if you understand that returns are uncertain and volatile, then trading can be a career path. But it is not a shortcut to wealth for most people. It is a high-variance pursuit with structural disadvantages. Investing, on the other hand, is designed to be low variance over long horizons. It aligns you with growth rather than speculation. So when we ask, who wins after 10 years? The evidence points clearly. Statistically, structurally, and psychologically, long-term index investing wins for the vast majority of people. It wins not because it's exciting, but because it's sustainable. It wins not because it guarantees outperformance every year, but because it reduces the probability of catastrophic mistakes. It wins because it compounds quietly while you live your life. And here's the deeper truth. Most people who are drawn to day trading are not really seeking alpha. They're seeking control. They want to feel in charge of outcomes. They want to accelerate the timeline. But markets do not reward urgency. They reward discipline. 10 years is long enough for skill illusions to fade and for compounding to reveal itself. If you consistently earn market-level returns and avoid large drawdowns caused by behavioral mistakes, you are already ahead of the majority of active participants. That might not feel glamorous, but it is powerful. Think about yourself 10 years from now. Would you rather say, I tried to beat the system and sometimes I did, sometimes I didn't, or I owned the system and let it work for me? One path requires constant engagement. The other requires consistent restraint. One path may produce occasional adrenaline spikes. The other produces gradual confidence. And confidence built on structure is very different from confidence built on recent wins. Over a decade, the identity you reinforce becomes your default. If you practice reacting daily, you become reactive. If you practice contributing and waiting, you become patient. That identity spills into other areas of life. Patience in investing often translates into patience in career decisions, health habits, relationships. Reactivity in trading can bleed into stress responses elsewhere. This is not always the case, but patterns matter. So when you hear that most day traders lose money over the long term, don't just interpret it as a statistic. Interpret it as a structural warning. It is not about intelligence or work ethic. It is about probability. If 90+% of participants in a field fail to produce consistent profits over years, the burden of proof shifts. The default assumption should not be that you will be the exception without extraordinary evidence. Meanwhile, the default assumption for diversified long-term investing is that you will participate in economic growth if you remain invested and keep costs low. That is a very different baseline. And here's the final lens I want you to consider: freedom. Wealth is not about maximizing excitement. It's about maximizing options. Which strategy is more likely to give you options after 10 years? The one dependent on daily performance or the one dependent on global productivity and long-term growth? You don't need to predict next week's market move to build wealth. You need a structure that survives volatility. When you zoom out, the answer becomes less dramatic, but more powerful. After 10 years, the index investor usually wins. Not every year, not every month. But across the decade, the combination of lower costs, lower behavioral mistakes, tax efficiency, and alignment with economic growth tilts the odds heavily in their favor. And if you're honest with yourself, odds matter more than excitement. Because 10 years from now, you won't care how thrilling your trades felt. You'll care how much optionality you have. You'll care whether compounding worked for you or whether you kept interrupting it. You'll care about time freedom, not trading stories. So the real choice is not day trader versus index investor. It's urgency versus patience, control versus structure, stimulation versus sustainability. And if your goal is long-term wealth rather than short-term intensity, the evidence, the math, and the psychology all point in the same direction. Over 10 years, boring usually wins. But let's go one layer deeper because sometimes people hear this and think, it means settling. It doesn't. Choosing the index path is not surrendering ambition, it's redirecting it. Instead of trying to extract returns from short-term noise, you build skills that increase your income, your leverage, your network, your value in the real economy. You focus on what you can actually control. Over a decade, a 5% annual salary growth rate combined with disciplined investing can dwarf the marginal gains from trying to shave a percentage point off market returns. In other words, the real asymmetric bet is often on yourself, not on intraday price movement. And there's another compounding effect most people miss: mental bandwidth. If you spend hours each week thinking about trades, managing positions, reviewing charts, that is energy not deployed elsewhere. Over 10 years, redirected energy can build businesses, deepen expertise, strengthen relationships, improve health. The index strategy protects that bandwidth. It creates space. And space is underrated. Space lets you think long-term. Space lets you avoid emotional decision-making. Space lets you weather downturns without panic. When a recession hits, and it will at some point in any 10-year window, the day trader may see volatility as opportunity, but also as threat. Leverage can magnify mistakes. Sudden moves can wipe out months of gains. The index investor sees red numbers too, but if they have a steady income and an emergency fund, downturns become discounted buying windows. History shows that markets have recovered from crashes, wars, pandemics, and crises over long horizons. That doesn't mean there's no risk. It means the risk is different. One risk is volatility in price, the other is volatility in behavior. Over 10 years, behavioral volatility is usually more destructive than market volatility. So when you choose your path, understand that you're not just choosing a return profile. You're choosing how often you want to test your own discipline. The more frequently you're forced to make high-stakes decisions, the more likely you are to make a costly mistake. Reducing decision frequency can be a competitive advantage. Automation can be an edge. Boredom can be a moat. 10 years from now, the person who consistently invested in broad markets, ignored the noise, kept costs low, and focused on growing their income will likely stand on a foundation that feels stable. The person who chased every breakout and breakdown may have stories, lessons, and maybe even some big wins, but the statistical odds suggest their financial base is less predictable. And predictability is powerful. It allows planning. It allows risk-taking in other areas because your core is steady. So if you're asking who actually wins after 10 years, the honest answer backed by data and human behavior is this: the investor who respects probability, controls costs, manages their psychology, and commits to a long-term process wins more often than not. And more often than not is enough.